Drop it.
Welcome to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long and Foster, joined as always by my partner in crime,
Michael Becker of Sierra Pacific Mortgage. I'm going to slow it down a little bit, dude. You said, do you have too much coffee? You were speaking really quickly there.
Well, it's fine though. It's fine. It's all good.
Exactly. Well, you know, when you speak publicly, sometimes you talk really fast. I've been told that before that I speak.
There are
quickly.
times, right? When I bring in the show, I always do
You're
that because I get past that stuff.
You're jacked up.
Yes.
Is it because it's National Jerky Day?
It's
Beef
partly
jerky
because
is one
it's
of your
National
favorites.
Beef Jerky Day.
Right, that gets you excited.
Brought to you by Chumps.
Well, if I go to Rural Farms, I get a free piece of jerky. Although I guarantee it's empty. Anytime they have you one of those free things on the apps, you show. If you don't get there by 8:30 in the morning, it's gone.
Yeah, it's all gone.
It's gone.
Right.
So.
Yeah. But so partly because it's Beef Jerky Day.
Okay.
Partly because we have a guest with us
That's a
today.
reason to be
That's
excited.
awesome. Yeah. So Jason Peebs with Edward Jones is joining us today. Jason, how are you?
I am well. Happy to be here.
Awesome to have you, buddy. And we are the whole purpose of today is we're going to talk about little
Dollars and cents.
Dollars and cents.
How do you spell cents?
SENSE.
Correct.
Yes, that's how creative we are here.
I am in a room of
Geniuses.
fellow dad jokesters.
Oh, hell yeah. Oh, guys, seriously, the last couple of days, I've been, the emoji thing on your iPhone where you can record in a character thing.
Right.
So
You've been doing
I
your
get
dad.
on there and I record a dad joke and then I send it to my kids, and my wife.
They're probably stopping.
Yesterday, she's like, "OMG, please stop."
Stop. Please. For the love of God, we beg
For the
you.
love of God. But it was, yeah. So, but I view that as my sacred responsibility.
Of course it
as
is.
a father, right? Having taken abuse.
There's a
for
guy on
years and years
TikTok
and
who
years.
does a whole thing, and he's got this funny laugh at the end. Almost like Snidely Whiplash at
Right.
the end. And it's dad jokes.
Yes.
But
yes, absolutely.
How about that reference? I don't know how many people remember that.
Snidely Whiplash.
Yeah, Dudley Do-Right.
Right, yeah, absolutely.
Sorry about that. Getting off. Anyway,
We're
the
good.
show's about dollar and cents.
Dollars and cents financial planning for home buying. So it's going to be a great episode. We took a break this past week, and it wasn't because we were being lazy.
And it wasn't because of the Memorial Day
Wasn't because of the
holiday.
Memorial Day holiday. We are committed to bringing good, timely information every week to everybody, but it was an important time for us to take a little break.
I had a little tragedy in my family, and a lot of people.
Yeah.
The good part of the tragedy is the number of people who reached out to me and told me and showed me that they cared. It was really
Absolutely.
heartwarming, and the way it brought the family together is also important.
It makes you realize how life is precious, how you tell those that you love them, right? Make
Not only that, the other thing I thought about too, you're absolutely right about the 100%. Say yes to everything is one thing I've been saying now. Instead
great.
of not finding time to do it, start saying yes to everything you can possibly do.
Yeah.
The other thing that's important is to give forgiveness.
Yeah.
In places where you've been withholding that. That's really important. The only person you're damaging by holding a grudge or not forgiving them is yourself.
That's a great point.
So,
That's a great point.
all right, enough of the somber tone. Let's
Thank
get
you,
back
Father
to
Michael. That was great. That was a great message, though. That was absolutely. Okay. All right. Well, so some pretty exciting things going on in the sports world, though. Royals are coming back up, right?
Yeah, they had a
little bit of a blip.
I think 3 or 4 in a loss in a row. Now they're 4 wins in a row.
Right.
And last night was
quite a homer.
At home. Somebody
yeah.
been waiting for Gunnar Henderson to hit one of those 460-some feet, Jason, was it?
A monster.
It was a
Yeah.
monster. Longest one during a live game. I think we were talking about this before. I could be wrong. Anybody who's listened, research it. But I think Ken Griffey hit the warehouse during a home run derby when the All-Star game back in the 90s. It was like 95 or 6 we had the All-Star game.
Yeah, maybe.
In Baltimore.
Yeah.
And I think he hit the warehouse. But I think this in a live game, this was the farthest ball. Boy, did he crank that.
Yeah. Pretty
Very
impressive.
exciting.
Very exciting. And I'm going tomorrow night.
Lucky
Very
you.
excited about that. And it's going to be in, here's upper 70s. sunny tomorrow. I mean, rainy. It's raining today when we're recording this, but tomorrow it's supposed to be upper 70s. Perfect baseball weather. It's going to be awesome. Yeah, can't wait to go. And with the shortened game clock,
I know.
It's going to be more exciting. You're not going to be able to walk away and you're going to miss too much now.
Because, pitches happen so often. You're right. You'd have conversations because it takes so long to pitch a ball or something like that.
Right. Not anymore.
Yeah. You have to pay attention.
You like the pitch clock?
I think it's interesting. I mean, me, anything speeds it up. It's good. No.
My grandfather.
I love the pitch clock.
I do too. Yeah. My grandfather used to hate watching baseball. He said, get in the batter's box. He's screaming. Mike Hargrove started it for the Cleveland Indians, who are now called the Guardians.
And
he was the guy with the gloves, fixed both gloves,
and
it would take him forever to get in. He would
just
scream at the TV, get in there.
Yeah.
In fact, he would scream at just throw it. Pitcher, get your signal and throw it. If he's,
Yeah.
Umpire, that's what they're doing now, and it's a good idea. It definitely speeds it up. I mean, if they want younger generation of fans to be developed, the game has to go faster.
Yeah.
It's too boring for the...
I can't watch it at home on TV. I can only watch baseball at the park.
I was going to say the generation that has they have a
shortened attention span
of a goldfish, 4.6 seconds or something like that.
Right. Yeah.
Anyway.
Yeah. But it's true. I can only watch it at the ballpark. I can't watch it on TV. I can watch football on TV all day long.
Yeah.
In fact, I actually prefer to watch football on TV.
I do too.
Yeah.
I like going to games. The experience is nice, but
it
can be. There's been some games that I was miserable. Why am I here?
Right. When it's 30-some degrees outside, and you're thinking,
I went to the San Francisco.
I have a widescreen TV that I could be watching the sun at home and be comfortable. And in my pajamas,
and you could have a hot dog that cost you 50 cents instead of $12.
Yeah. Well, 5 years from now, I'm thinking we might be telling, people stories about. I'm old enough to remember the 7th inning stretch.
Right.
Yeah. Which president
was
that? Was it Wilson? Somebody. What president created the seventh inning stretch?
I don't know. I know it was Howard Taft who threw out the first ball. But
I think it might have been, maybe it was Woodrow. I don't know. Somebody will tell me. Maybe it was Woodrow Wilson stood up in the 7th inning. Everybody else did because he was the president, and that's what started the 7th inning stretch.
Because no one thought of the pitch clock back then.
Yeah, right. So now we can say, screw you, president. We're going to just do what we want. Anyway.
There we go.
All right, well, listen.
Howard Taft.
It was Taft. Oh,
and he was also the one who threw out the first pitch. Interesting. He stood up at stretch. It was so he was the president probably before Wilson because it was 1910. So
yeah. It's been a while.
Yeah. Over 100
but anyway, so there you go. All right, a little bit of history today.
All right, let's do the rundown, my friend.
Let's go into the rundown. Michael, what you got for us on the mortgage front?
Since we took a break, I went back and looked at the last 2 weeks, and unfortunately, it's not necessarily good news. We've seen rates spike close to 7%. They got a little bit above 7. They're a little bit below it. So it's not surprising to see them go down.
Yeah.
Overall, last week, the week ending June 7th, according to the Mortgage Bankers Association, we had a 1.4 decline in mortgage applications. Now, that's a seasonally adjusted number. And I thought, I said, well, that's not too bad. But then, because this is the time of year when mortgage applications should be going up. Because a lot of people are buying in the summertime. Right. Kids are out of school. It's when people like to move, so they're ready for the next school year.
Yeah.
And when I looked at the unadjusted numbers, that's where it really popped. It's down 12% week over week, unadjusted.
That's the thing with inventory too. This is the season when we think all the inventory is
there should be. It should be increasing, and it's not.
Yeah.
The week prior, the week ending May 31st, we also saw a 3.7 on a seasonally adjusted basis, 5% on an unadjusted basis. Rates kind of did improve a little bit last week. According to the Mortgage Bankers Association, they dropped this from 6.91 to 6.81. I checked today before we went on the air, Mortgage News Daily, who we like to check on a daily basis because they
6.97.
That's exactly what it was, just below 7%. I think it might be a little bit better. I looked at my rate sheets. For high-quality bars, it's a little bit better than that. But we are, instead of the low 6s, we're in the high sixes for now.
But at least it has a 6 for
now. Looking forward, we have incredibly important data points
coming up
this week. Tuesday, June 13th, is the Consumer Price Index. I think the headline number is going to show good improvement. In fact, I think it's going to be somewhere in the 3s.
Yeah.
But that's not what the Fed's focusing on. They are looking at core inflation.
Right.
And core inflation is going to should be somewhere in the fives. It might decline a little bit. I think the prediction is 5.3%. I always check out what the Cleveland Fed does because they have an inflation now forecast, and they're forecasting 5.1. If that happened, if it comes in line or slightly better, we might see a little rally in rates. But it'll be short-lived because the big news is Wednesday afternoon when the Fed concludes its two-day meeting and they come out and announce it. I think that most people, the Fed's futures markets are kind of on the side of them pausing for now. Yeah. But I guarantee you during Chairman Powell's news conference, he's going to reiterate data dependency. Right. And he may even mention the jobs report that came out last Friday. The headline number, 341,000 jobs, is a lot stronger than expected. And the Fed has been raising rates, and the reason they want to cool the jobs market is so that wage inflation cools, which tends to feed its way through all types of inflation. If people have more money, they're going to spend it. If they have less money, demand drops, and inflation will cool. And that's the idea behind it. I think it'll be a pause. I think mortgage rates will probably, it has been the history that the markets have looked for good signs from Chairman Powell, and bond markets have rallied after his speeches. So I probably, if I had a loan to lock, would probably lock after the Fed meeting. But I'd have that finger on the lock just in case he says something.
Ready to go, right?
Exactly right. In case he says something that shocks market. I don't think he wants to. I think he's happy where rates are. If they have to go higher, he's fine pushing it. He definitely doesn't want inflation to keep continuing getting worse.
Right.
I mean, it's
a big concern. I mean, there was an article in the Wall Street Journal this morning about how he's in the toughest situation possible.
Well, the problem is that the Fed is doing all it can as far as raising rates. We don't have a fiscal policy that's aligned with our monetary policy.
Yeah.
There's way too much federal government spending.
Yeah.
They need to curb it. When they had the debt ceiling, I was hoping Republicans would kind of actually look for actual cuts. A cut in congressional parlance is a reduction in next year's increase. That's not a cut. It's just dialing back our increases. We already have too much money out there, right? Didn't Milton Friedman say inflation is always and everywhere a monetary phenomenon? And the way the federal government increased the money supply is by deficit spending, which forces us to issue debt securities, treasury bonds, and bills, right? Notes. Yeah. So anyway, enough of that. So I'd like to see a little rally here. It's just we're going to be data dependent. I think we'll see a little rally after the Fed meeting, but it might be short-lived based on what data comes out after that.
Yeah. Okay. Great. All right. Well, so let's roll into the real estate market. We have the monthly market numbers for May now. They just came out today. So closed sales, they're down to 3178 for the month of May. Our 5-year average 3635, so we're off the 5-year. Everything's down. New pendings 3427. The 5-year average is 4496. Active listings is down.
Jeez.
Yeah, only 3640 active listings. The 5-year average is 5369. And the months of supply we have for the Baltimore metro region is 1.3 months of supply. That's ticked up just a hair from last month. We were at 1.1, but it's still a big issue. All right, so total volume sold in the month of May, $1,358,000,000 and change. That's down year over year 18.5%.
The dollar amount is?
Yes, wow. The sales volume.
Given the increase in prices, that's a striking number.
It is, yeah. So closed sales down 21%. Median sold price was flat at $375 year over year. The average sales price was a slight tick up. But median days on the market flat, 6 days. Things are going quick.
Yes, they are.
Yeah, they're very quick. And then the median sold price I also broke down by county. Most of the county, well, 3 of the counties are down. So Carroll County down 4.6% for the median sales price. Harford County down 3.5%, and Baltimore City's down 8.2%.
Median sale price.
Median sales price in
could that just be the specific homes for sale? Because that's surprising.
It can be right. I mean, it's something to watch, but we've seen Baltimore skirt with that for a little while. The other three, Baltimore County and Howard County and Anne Arundel County, were all up, but not significantly. Baltimore County was up 2.4%. Anne Arundel County was up 6.3%, and Howard County was up 1.6%. Now, I also pulled, because, as you know, I'm a fan of comparing not just year over year, but also year over back to a pseudo-normal market of 2019. I wanted to pull the numbers just to give you an idea. So 3,178 sales in May of 2023. In 2022, there were 4,022. So we're down almost 1,000 from that, right? Mm-hmm. In 2019, not quite as bad. 3,787. We're still down from a normal market, but not quite as bad as from the previous year. New listings, we're down a lot. 3,353 in 2023. In 2022, it was 4,989, and in 2019, it was 6,476.
Wow. That's
so
shocking. It's a striking. Now you know why they're,
despite
almost 7% mortgage rates, why there's still so much competition for every single.
Right. Because the new listings aren't out there. All right, so here's the worst part. Active listings, right? So there's a difference between new and active listings. So this is all the properties that are on the market. Active listings for the month of May, 3,640 this year, 3,468 last year, so it's slightly better than last year. But 2019, 10,087. So
wow,
way off a normal year.
Wow.
For active listings. And then to Michael's point, what he just said, that's why there's so much competition. That's why home prices aren't going down significantly.
People are now, I mean, the coming soon
Yep.
is what people look for. It's like if you see a house that's listed for 2 days, you might not even have a chance to see it.
Right. That's one of those, you remember what was that, the commercial where the guy had the fishing reel throwing the dollar out and he's like, oh yeah. Just missed it.
Just missed it.
Can't remember that one. But yeah. But it's just like that, right? Here's the house. Oh,
that's what it feels
just missed it. Yeah. All right. Median sales price, like I said, was flat, but look at it compared to 2019. $293K was that median sales price in 2019. So to get to $375 today, homeowners have a lot of appreciation. Yeah. And that's a huge benefit to those homeowners. So a lot of folks probably don't even realize how much equity they may have in their homes right now. It's a good topic for you, Jason. But anyway, all right. Sales price to original list price ratio, 100.9 2023. In 2022, it was 102.7. In 2019, it was 99.2. So again, last year, crazy frenetic pace. Homes were going much more over list. Now they're going somewhat over list, but we were right around list in a normal market. All right, days on the market, 6 days, pretty flat from last year. 2019, normal market, 15 days. So we're less than half of what that is. And months of supply, as I said, we were around 1.3. It's actually 1.25. Last year, we were only at 0.86, so less than a month of supply. More normal market was 3.3. And that was even down because, but I think I mentioned in previous podcasts, the last time we had a balanced market, 6 months of supply, October of 2014. So it's been that long.
We said this in the past. I think that metric is probably going to have to change.
It's going to be, yeah.
It's how fast things can move, given technology. 3 or 4 months. How delighted would you be if you had 3 or 4 months of supply?
It would be wonderful. And when it was 3 or 4 months, we were still getting seller help and upfront seller help. Right. So anyway, all right. So that's the market activity. We're going to have a great episode today. As we mentioned, the episode Dollars and Cents, Financial Planning for Home Buying. We're going to get back to that in just a second. Try it. And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Long & Foster, sitting with my bud,
Michael Becker of Sierra Pacific Mortgage.
Thank you, Michael. And our guest, Jason Peeps with Edward Jones. Sup, Jason?
It's happening, gentlemen.
Oh, just having a blast here with you guys.
Talking about
dollars and cents. SENSE.
This is the Maryland Real Estate Podcast.
Yes, it is.
Kind of makes sense that we're talking about that.
We're talking
Financial
about
planning.
money. Yeah.
Financial planning for home buying.
Right. So Jason's our residential expert in all things financial planning. So thrilled to have you here, ma'am. Thank you for taking the time. So, our thought is, whether you're a first-time home buyer, somebody who's been purchased a number of homes, getting your financial house in order. See what I did there? I brought it back to real estate. Yeah. Getting that house, the financial house in order when you're buying a home is super important. So we have a bunch of things we want to talk about, right?
It amazes me, Brad, that I'm glad you brought that up. How many people who contact me and want to buy a house, and they're so unprepared, whether it's not having filed a tax return, or they haven't looked at their credit, or
saved any money, or whatever it
money.
is.
I mean, they might financially be prepared, but there's a lot of things that go into doing it, and they want to go look at a house.
Oh yeah, because they've seen the one that they really want to see.
Well, if the second you have an inkling that you may want to buy a new home, is when you not only should get your financial house in order, but your credit, everything aligned.
Right.
So it's an easier process.
Absolutely.
Otherwise, you're scrambling to do things.
You're setting yourself up for disappointment
in a matter of minutes to get your offer in, because there's many times that you have 24 hours or less to get an offer in.
Dude, if you have to press pause after you've seen a house to go talk to a lender at that point, chances are you just missed that house.
You're going to miss out.
Yeah.
It's hard to impulse buy a home.
Yeah,
it's
not a smart thing to do either.
It's a good thing.
Yes.
Yeah. Oh, well, unless you're like, Elon Musk or something. Oh, I'll buy that one. I'll take that. Yeah.
But for us mere mortals.
Right. Yeah, right. Exactly. All right. So I got a couple of questions that I want to kind of just fire away at you, Jason. First one that occurred to me, if I'm thinking about percentages of incomes, like Michael, if he qualifies somebody for a loan, he'll look at what the loan limits are and all that kind of stuff. But you might have a different perspective on how much people should really put toward the home from their, as a percentage of income. And I was thinking it might depend on, kind of where they are in life. So what do you think about that? Where should people really be?
Beautiful question.
First, I'm a beautiful person.
That's debatable.
Thank you both, Brad and Michael, for having me on.
Our pleasure.
I was real excited to talk with you on this subject.
Thank you.
One of the questions I do get is, do you really personalize strategies?
Yeah.
And I think when it comes to talking about home buying, this is going to be such a great conversation because whether it's a first-time home, a move-up home, downsizing, it requires many different strategies.
Yeah.
So it's a very personalized process. So your question, ideal percentage of income or savings. And so I guess it's going to depend on, where you're at in terms of your first home or your move-up. So for first-time home buyers, save as much as you can.
Yeah, save.
It's probably a higher percentage. A move-up buyer is going to have the equity in a house that they're going to probably sell that may enable them to not have to save as much. Now, if they're moving up in value, and given where rates are, the monthly payment might be more. So they may want to think about putting more in so the monthly payment is more affordable for them.
Yeah.
Right.
Yeah.
First-time home buyers save as much as you can, and what I love about that, it's going to be training for life.
Absolutely.
You're establishing that habit of paying yourself first. Probably one of the first principles in retirement saving, just anything in life. Pay yourself first.
So my grandfather taught me that. When I said Josh and Matt down about budgeting, they wanted to rent apartments. So I told them to write a budget up. And I try to think of everything you possibly can.
Yep. I did the same thing with Anna when she was getting ready to move out to Chicago.
I looked at it and said, you're missing number one. I go, what do you mean rent's there, right?
Right.
I'm like,
no.
You got to pay yourself before you even pay rent.
Absolutely.
I know. It's a very important thing.
Yeah. Yeah, we did the same thing. Yeah, absolutely.
Yeah.
Beautiful. Okay.
Parents with kids, someone who already has a home, life's getting a little more complicated. Someone with kids.
You don't have any money to buy a home at the time.
Right? So it definitely becomes it's about balance and identifying your priorities. You got to throw in saving for college, most likely. How does that rate against saving for your ideal home? So really having a good idea of what your goals are and what your priorities are, that's going to help determine, really where that mortgage payment and how much saving is going to be put towards that home.
Yeah, beautiful. Okay, well, so both of you have already kind of brought up this idea, but let's talk about a budget, right? I mean, how do you sit down and create that budget that allows you to maximize those savings? What's the process? Is there a good, probably not a one size fits all, but a good set of principles people can follow? Yeah.
You said the B word.
Ooh.
Yeah, the B word.
Yeah.
I'll bring up budget.
I'm sorry, Mom.
And, it's
a dirty word, especially when you consider our government can't live within their budgetary guidelines.
That's very true. It's very true.
Yeah, we all have those words in our industry. You're not buying, you're taking delivery.
I like that.
So I love to use the term cash flow.
Yeah.
Let's optimize our cash flow. And how do we do that? So I recommend starting out. I think that what most people think of when they create a budget is immediately clamping down on spending and making
it's denial more than anything,
yep,
right?
Yep. And the success rate of that, as one could imagine, is probably pretty low. Start by documenting your spending.
Yeah.
Just start by taking a look at what you're spending, and
you're talking like create a diary, right? Like how am I spending my money every day?
Yep.
Yeah. It's a great idea, Jason. It's often I come across first-time home buyers, and especially now the rates are a little higher and values have gone up, and struggling to find something that fits in their budget. Well, one of the things I get during the process of pre-approvement is their bank statement, and most kids these days use debit cards.
Yeah.
So I get to see the daily deductions, and I've added it up. I've literally said, do you guys realize in the last month between Starbucks, fast casual or fast food restaurants, you spent $500 or some number?
Yeah.
If you brown bagged it a few days a week, if you brewed coffee at home, just little simple things like that make amazing differences in their budget.
First thing we did when we thought about Ryan going to college is we said, let's get him a coffee machine so he can, yeah.
Absolutely. And
I even have the oil. If you want one of those sweet ones, like I said, kids, that $7 Dunkin' Donut or Starbucks drink that you like?
Oh.
I can show you how you make it at home.
Yeah.
You can buy all the ingredients.
Right.
So when you keep a diary, those things are going to pop
jump
out at you. And rather than diving in headfirst, hacking and whacking at other expenditures, some of those things are going to pop out and you'll be able to make some adjustments pretty quick. But I think baby steps are key. It's really about understanding where your money is going.
Yeah.
And I think if you create a diary on your spending, there's going to be some surprises.
Without a doubt.
Yep.
Now, do you advise, like Michael said, the kids nowadays, I mean, everything's on debit card or credit card or whatever.
Right.
Is that a better way to go? Cash? I mean, sometimes cash hard to track.
Yep. So if you want that next level, high performance way of managing your cash flow, there's a reason we call it cash flow.
Yeah.
Right.
Cash.
Yeah.
Yeah, once it's gone, stop spending.
Right.
There's so many studies out there.
Hopefully before then.
Finance, like many things we have in life, it's emotional.
Yeah.
And they found when you swipe a card, it's much easier to separate yourself from that digital currency than it is to carry cash keep it in an envelope, in your wallet, your purse. Handing over that paper cash is painful.
It is.
And you're far less likely
I have
to
a
hand
mental
it over.
block. I have a mental block. Every time, I don't carry much cash with me, but every time I pay with that dollar bill, with the whatever, and then I see how much less I have, because it's right there in my wallet. Ooh, yeah.
So, Dave Ramsey, I think many of us have heard of Dave Ramsey. He's got a great book out, and some of those principles he talks about, putting cash in envelopes, using that to pay for your expenses. You know, it's a great way to really control the emotions of spending. And,
or inflict pain, because I like that. I mean, it is. It's painful.
Right.
Ooh.
His big saying, which I love, is live like no other so that you can live like no other.
Yeah, right.
Yeah. And
Good.
so, creating that budget, managing your cash flow, start with a diary and start managing those things that.
It's the one thing you can manage the most. I mean, there are ways to make more money. There's two sides to the ledger, right?
Sure.
There's incoming and outgoing.
Right.
And you can, by working harder, taking up a second job, increase your income, but it's a lot easier to control your spending than it is.
Oh, I can't tell you how many times I've listened to gurus say, you don't have a debt problem, you have an income problem. Yeah. True.
Yep. Yeah.
But it's because I spent so much money.
Go get the side hustle, change careers. That's a lot of work.
Yeah, it is.
There's nothing wrong with looking for a side hustle or picking up ways to make extra money.
Yeah. Nothing wrong. Multiple streams of income are a good thing.
It's not a bad idea.
Yeah. Plug up the boat.
Yeah, absolutely. Yeah.
I like that. All right. Well, so how about strategies, specific savings or investment strategies that can help you accomplish those goals quicker? I mean, you talked a little bit about, the envelopes and things like that, but what else?
Sure. Step one, get that budget, that cash flow plan in order.
Yeah.
Another strategy, this might seem a little obvious, but don't go into debt.
Yeah.
Stay out of debt.
It's so easy to do.
It is.
Going to debt, like you said, credit cards are, once you've established your credit.
That's why they call it a slippery slope.
Yes.
Yeah.
Right. Well, not only that, and that when you buy, it's easy because the price of cars is going crazy. Not only used cars.
Yes.
Yep.
And the people, I don't think there's debt to income calculations done when you go to qualify. If you go to a dealership, they'll find a way to get you the car you want.
Oh, sure.
And they may put you in an 84-month. I'm waiting for the 96-month car loan.
It's ridiculous.
Yeah.
But to pay for a car for 7 years?
Oh, look, we had somebody who we were talking to who made like $75,000 a year. Not a bad income.
Right.
Bought a Mercedes. Brand new Mercedes.
Right.
For the monthly payment on the Mercedes was over $1,000 on their vehicle.
Right.
Yeah. Just not the smartest move.
Yeah. First-time home buyers going into massive amounts of credit card debt. I think Einstein called compounding interest the eighth wonder of the world.
It's the strongest force in the universe may have been, but that's also applies.
We can get all heady and higher level financial strategies about debt. Not all debt is bad, but I think if you're saving for your first home, keeping that debt low.
Revolving debt, things, credit card debt, things like that. Those are the issues.
Yeah, absolutely.
Yeah.
I said a moment ago, plug up the boat, stop the leakage, look for ways to, reduce your tax burden. So maybe you're already in a home and you're starting to save for that next home.
Mm-hmm.
Reducing your tax load can, if you could find a way to reduce your taxes by 5% in a year, I mean that's
easy peasy. Don't make as much.
Yep.
Right.
Yeah, you don't want to do that.
Yeah.
Right. But how does somebody do that?
Well, It's going to be a reoccurring theme here today, but talking with your financial professionals.
Yeah, sure.
Your CPA, your investment advisor, your financial advisor.
Especially when it's a couple or a young couple,
Right.
because there's strategies that I would think that they could do. In my personal experience, I've subsidized my better half's income in order for her to maximize her retirement savings.
Right.
Sure.
And I paid for things that she normally would pay for because of where her income is, and it allowed her. And that's an important discussion to have, and it's always a smart tax move. Make sure I've had people ask me, how do I lower my tax burden? I said, for number one, maximize your retirement savings.
Yeah.
You know?
Yeah, absolutely.
Yeah.
Absolutely. Well, I have one
Okay.
that maybe a whole lot of people don't know about. And it's because it hasn't gotten a lot of press since it became law.
What's that? Well, here's the surprise that's coming.
This is the
I
surprise.
figured.
Yeah. There was a bill, House Bill 1178, that created the first-time home buyer savings account.
Oh.
And most people don't know anything about this because it's been tied up with execution, right? How are we going to roll this out? What are we going to do?
Right.
And so nobody really knows about it yet. But here's the thing. You now have a tax-free way of saving for the purchase of a home in a savings account. And oh, by the way, it doesn't have to be a specific product that you get from a specific bank. You can use any savings account as this tax-free savings account, and as long as it's used for the purposes of saving for and purchasing that home as a first-time home buyer in the state of Maryland, and there are some other rules, but
This is a Maryland
it's
program?
a Maryland law that went into, yes, it was a big push by Maryland realtors to get this created, but it's a big thing. So talk to your financial planner, go to your bank, but you can use any savings account for it as long as it's the exclusive purpose of that account is to save money and you can save a pretty decent amount. I think tax free, you can save up to $5,000 a year for 10 years. So $50,000
state tax free.
State tax, correct.
That's a beautiful thing.
Yeah.
So we'll probably get into some of these other ways that I think are far less advantageous than this type of savings plan.
For my kids, given where their income level is, again, Jason's the expert. I just articulating some ideas that I gave them that I suggested that instead of, because they're not going to a higher bracket if they put, or a lower bracket if they put money into a tax deferred plan. I suggested starting with Roth 401ks or
Sure.
Roth IRAs, because the cool thing about that when it comes to buying a home, after you've established it for a while, you can pull that money, the initial contributions into it, you can pull it out and there are no tax implications whatsoever.
It's nice.
I
think if you're pulling it out of your 401k,
$10,000 for first-time home buyers. I think
Right.
you can use
yep, penalty free.
penalty free.
Yeah,
Now the
One of the
drawback of that is
it's one of the few options to withdraw penalty
now the
free.
drawback of that is what Einstein talked about compound interest is you're going to lose that by pulling
Right.
that out. It's a lot better than say sticking it in a 0.1% APR savings account that some banks will give you these days.
Yes.
Okay, so we've talked a lot about the types of accounts and financial interests, instruments, things like that. Is there any other thoughts you have on saving?
Yeah. So I guess a word of caution. You can use your 401k. You can use your IRAs. First-time home buyers have the ability to take a withdrawal penalty-free, because that's the key word. Unless it's for a first-time home purchase, you could incur a 10% penalty. And that's on top of any...
On top of the tax implications of taking
Right.
it out as
Yeah,
well.
and that's all that growth you were seeing in those accounts. It wipes it out. So be careful. For someone saving for their second home or a move up, there's some other ways of saving there, and I'd recommend maybe a straight investment account without any penalty for the withdrawals.
Yeah.
Otherwise, take a loan. Loans are penalty free. That could be a good option as well.
Good. Cool. All right. So this is a topic near and dear to my heart because my kids are pretty young and getting to this point, right? If I'm a recent college graduate, I've worked with some people they've graduated and they've got $250,000 in college debt. It's crushing.
Right.
Can I buy a home if I've got all that college debt? And how can I deal with that?
Yeah. And I know Michael could talk circles around me when it comes to DTI.
Yeah.
Well, I could talk a little bit about that, but so there are challenges. Especially now, over the last 2 years, it's been a lot easier because most of them have been put on hold.
Right.
And certain programs require anywhere from 0.5% of the amount to 1% for a monthly payment. So
right.
For
so
$2,500, that'd be $2,500, $1,250 to $1,200
against your DTI.
Against your DTI.
Yeah.
Now, it is my hope. And it may be an unfounded hope, but it's my hope.
We can all dream
that if you've taken on that much debt, that you have advanced degrees, that you earn a degree that's going to really amplify your earning potential.
Right. Or that you go into an industry that will waive your debt for service.
Well. There are some health fields where you can have a reduced payment, and after a while it goes away. And if we verify that you're set up with that type of payment plan, we can use that, and that'd be less of a hit to your debt to income ratio.
Yeah.
But it is a problem with a lot of people who will struggle to buy homes because they took on. I don't know that it will end it. I think what it tends to do is delay it, Jason, from them being able to save for a home, because it may take a few more years for their earning income, their earning potential to increase to a level where they can handle that college debt and also
save for retirement, save for their home,
all those things.
Now, there is some good news.
Okay,
all right.
So how do you do all of that?
Magic.
Yeah. December of 2022.
Yeah.
Congress passed this massive omnibus bill called Secure Act 2.0.
Right. Yeah.
And it modernized a lot of the laws we have in tax code around investments and saving and retirement. One of the provisions that came out of this big bill is it's for these again first-time home buyers and college grads that they have student loans.
Yeah.
So you're trying to pay off your student loan. You're really scraping, 1-2% if you still have that to get your employer match in your 401k.
Mm-hmm.
So, came up with a great idea. Employers can now take your college loan payment as a match to put into your 401k.
I love that idea.
That's cool.
So if you're paying your student loans and not putting any into your retirement account, they could match what you're paying towards your student loans to put into your account.
That's exactly right.
That's brilliant.
That is brilliant.
Which allows you to, the college grad, to put that money back into savings for that first-time home.
Wow.
Yeah.
I like that.
Yep.
I have to tell my kids to see
that.
if their employers have that program.
Yeah.
Absolutely. So even if an employer doesn't have it, they can talk to their 401k plan administrator. Mm-hmm. They can update their plan. They can incorporate this provision, and it starts in 2024.
I think it's a great product to have, especially as tight as the labor market is, to actually get the talent that you want to work for yourself. What a great way to offer ability to save without having to come out of pocket when you're struggling with student loan debt. Great.
Fantastic idea.
Yeah. After I think...
Wait a minute. The federal government did something cool?
Sometimes, right?
Yeah, I was real excited to see that provision.
I love that. It's so much better than, well, I'm going to pontificate here. always pause before I say something because I don't want to upset people. But I have opinions, and I'm entitled to them.
You are.
And I think it's so much better
Everybody's
than
got one.
eliminating student loan debt and putting that burden on many people who never went to college.
Well,
it doesn't seem to be it. That's not a fair thing. That's more of a vote-getting thing. This seems incredibly fair.
It's a win-win.
I like it.
Because employers, they have tax advantages for offering a match and contributing to their employees' retirement fund. And it's beyond, they have tax incentives, but it's a wonderful benefit. Happy employees, productive
absolutely
business. It's a win-win all around.
Yeah, I love it. All right, cool. All right, so let's move away from the college grads. Say I own my own home already. Are there smart ways to purchase a new home without, this market? Pretty tough market, very competitive. If I offer on a home that, hey, I want to buy your home, but I have to sell my home first.
Right.
That contingency very often looks to a seller much less attractive than somebody who doesn't have that. So they're just not getting. They're not getting accepted.
Tell it like it is.
They're not getting
You're
accepted.
not getting a contingency accepted in this
right,
market.
not in this market. So the point is, are there ways that I can do that without having that home contingency?
Right. It reminds me of that phrase, luck favors the prepared.
Yeah.
So you already have a home. So if you're being diligent about saving and you're going after some of these other investment strategies, there's a few things you can do to leverage your financial situation into a second home purchase or that move-up home purchase. Assuming you've been contributing to a 401k, you've been employed for some time now, you can take a loan on your 401k. Do not take a withdrawal.
Right.
There are penalties, as we discussed. You can take a loan, assuming this is short term, and you don't want any contingency on that home you want to purchase.
Right.
Stay in your home. Take a loan in your 401k to cover that gap that Michael might see.
Yeah.
Get you over the hump.
Yeah. Yeah.
You can take a loan. You'll have a 5 to 9% interest rate, most likely.
You're paying yourself, though, right, that interest?
Yeah.
100%.
And from an underwriting standpoint, 401k loans, your own loans, do not count in your debt ratio.
Yeah.
So it makes, from an underwriting, because you're paying yourself back. So that even though it's monthly, it may even be often it's a payroll reduction, so it automatically comes out of your pay to pay yourself back. But it's not looked at as an additional debt since you're paying yourself back.
Right. Excellent.
Yeah.
Okay. Very cool.
Another strategy, if you have a variable universal life insurance policy, these things are gold.
Yes,
so not only are you protecting your loved ones in case of your demise,
untimely demise.
there's a cash value that builds up in these policies, and you're able to borrow against that cash value. Again, I don't recommend a withdrawal.
Yeah.
But for the short term, while you're purchasing your next home, getting your existing home ready for the market, take a loan on that cash value.
Yeah.
And it's a great interest, tax-free way of getting some cash and getting you over the hump, so you can remove that contingency.
Like it. Cool.
From a lending standpoint, if you were a move up buyer, and you had the wherewithal prior to seeking out this new home, or have it established a large home equity line of credit, that often is something you can use as opposed to selling your house, because that line of credit will be paid off. Now you could take it out if you wanted to and then pay it off, but generally those lenders who do home equity lines of credit do them closing costs free. Yeah. But they require you to keep it open for 3 years. If you don't, you'll have to reimburse them for any of the closing costs they paid for you. So some of Jason's ideas would probably be a cheaper route. But there are people out there. I mean, one of the nicest things I love seeing is I see somebody who's a move-up buyer, somebody who wants to buy a new home, have a large existing home equity line of credit already established on their credit report, and borrowed funds are always, from an underwriting standpoint, are allowed to be used to purchase a new home, but those borrowed funds must be leaned against something. So you cannot do cash advances on a credit card. It's got to be leaned against something. I've seen people put a loan on a car or exotic car that they had in order to come up with money. So it has, if you borrow money to buy a new house or come up with a down payment or closing costs, it has to be leaned. And again, that monthly payment does have to go into your debt to income ratio. That's why Jason's idea of the loans are much preferred from an underwriting standpoint and from an earnings standpoint.
Yeah, absolutely. Okay, great. All right, so we've talked about kind of normal buyers, first-time buyers, move-up buyers, that kind of thing. What about if I'm thinking about investment buyers, Jason? If I'm thinking about ways to improve my overall financial standing, do you like the idea of including rental properties in somebody's portfolio?
Man, I love real estate.
So do we.
So it should,
right?
Well, I always say to people, if you want to have a diversified portfolio, which is the safest way to grow your money, real estate should be part of it.
Yeah.
Some way, shape, or form.
Yeah.
Completely agree. So where I start this conversation when someone asks me about buying a rental property, maybe getting into a flip, I start the conversation at their risk profile.
Yeah.
Good point.
With every type of investment, it carries a certain level of risk.
Mm-hmm.
I met someone, and we had conducted a risk profile, and it turns out he's fairly low risk. Very concerned about swings in the market, and he'd probably get out if the market dropped too much.
Yeah.
And then he started talking about real estate, and someone like that, I'm not sure if real estate is ideal, but someone with a more medium to higher risk profile who is, it's about planning.
Sure.
All right. And so if you're at a state in your investment history where those swings in the market are going to be a little more difficult to weather,
Right.
Might
The
not
older
be the best
you
thing.
get,
There's other ways of investing in real estate, but
Yeah.
buying a property.
Yeah.
So I'd take a look at the risk factor first. Definitely have a business plan.
Yeah.
A rental investment is fantastic. What I've seen in the past, and I'm sure you've seen this as well.
Mm-hmm.
So excited to get into the rental business.
Yeah.
They even had a business plan.
Mm-hmm.
But it's been 2 months and they haven't found the rental property yet.
Yeah.
And they get desperate and they blow their business plan and they go find someone that's not fitting in their numbers. You're already off on the wrong.
Yeah.
Well, beyond that, I mean, so from a rental standpoint, not everybody's meant to be a landlord. There are challenges with being a
Absolutely.
landlord. I often recommend anybody who wants to go that route to seek out a professional management company and calculate that into your factor.
Right. And if the numbers don't work, then don't go down that path.
Don't go down that route.
Yeah.
It's also a time game. It seems to me the longer that you can do that, the greater the profits.
Well, because you have all the cash flow every month, but then you also have over time the appreciation.
And it tends to fix things out.
Yeah.
Right.
One thing that should be factored into it, like every one of our other discussions as far as saving for a house, are the tax implications. And there are some great tax implications when it comes to own and rental real estate. Now, what people tend to forget is on the other side of it, when you do sell that property, for example, you can depreciate a property. You could have a positive cash flow, but you could show no income on that rental property because you've been depreciating it. At the end of the life, when you sell it, if there is a capital gain, you have to do that. And then you also have to recapture depreciation. So
Right.
that's something that you have to think about as well as in factoring in your returns. I will say, from my standpoint, though, some of the tax savings from using depreciation and owning rental property have been wonderful for me. I'm okay because the recapture is going to be at a lower percentage than at the time the tax rates I were paying.
Yeah.
So,
Yeah.
but again, what do we always say, Brad? Seek
the counsel of a financial planner
or
and your tax advisor.
Exactly right.
Yeah.
Absolutely.
Yeah. Good.
Yeah.
All right. Cool. So Michael alluded to this earlier, right? I think one of the things that people often forget, they decide they want to buy a house. They save up the money for the down payment. Maybe they even remember to save up the money for the closing costs. But that's all they've saved, and they think they're ready to go. It's more than just saving for that down payment and the closing costs. But then there's also you've got to have a plan for building your overall financial health, right? So, how do you balance those needs, right?
Great question.
Michael talked about paying yourself first earlier, right? And you did. Yeah.
He said I agreed with it.
Yes, right.
Give credit where credit's due.
If we're keeping tally here.
Yes, right. 2 points. 2 points to Gryffindor. No. But anyway, yeah. So how do you balance this?
Yeah. I mean, if that's not the question of life right there.
It's a great question, and
yeah.
a lot of people forget about that. They're excited to own a home, and guess what? This is what I'm sorry to cut you off, Jason, but I always say that owning a home is more of a forced savings plan, and it's incredibly hard to get at that savings, right? So you cannot put all your eggs
in one basket.
In that one basket.
Right.
Yeah.
Yep. It just, it reminds me of, a lot of folks, we have hopes and dreams, and I've always wanted to do this. I always wanted that. And, the more complicated life gets, some of these hopes and dreams just don't come to fruition. Because one, there isn't a plan. It gets a little too complicated for someone to just kind of manage themselves. Prioritizing and coming up with a plan is the only way you're going to get through that. Some of these goals, you're going to have to focus on one goal before the next. But having a plan, our financial situation is a lot like our health, in so many ways. And our wealth and our savings and our ability to maintain that cash flow plan, that budget, we tend to get comfortable with a certain way of life. And getting uncomfortable is where a lot of the gains are seen.
Yeah,
that's
a great analogy. The other way that I was thinking about that was, if you're stressed about not having a lot of money, you're also kind of probably not feeling great yourself.
Right.
Well, no, that'll affect your health. Money problems do tend to affect your health.
Yeah. It's, in health, calories in, calories out. Mm-hmm. It's, that's where our goals are met. In those numbers. And it's the same financially speaking, cash in, cash out.
Yeah.
What are we doing with that margin? And so sitting down, like any goal, we're able to take a look at where we're at today, where we want to be tomorrow. What are the steps to get there? And prioritize those goals. Maybe we can't work on multiple goals at once, but what's the most important?
Yeah.
Focus on the most important.
Great point.
Yep.
Yeah.
And eventually you will get there.
And it changes over time too, because you could set a plan in motion and then things change. Incomes increase, jobs change, there's lots of things change.
Sure.
That you can, and you have to, I would imagine, adjust those plans as time goes on.
Yeah.
This is a lifelong
it's an organic kind of living, breathing thing.
It's not something you set up once you graduate school and buy your first house and then it's on autopilot forever. It just doesn't work that way.
Life happens.
It does.
Yeah.
Get your plan in place. Consistency, being consistent in contributing to your goals, paying yourself first. A lot of these concepts will show up over and over again. But that's what I recommend.
Beautiful.
Get a plan and stick with it.
Beautiful. I love it. All right. Well, I think that's a great point on which to wrap up, would you say?
Absolutely.
Excellent. Jason, pearls of wisdom, man. Loved it. Loved it.
I appreciate it.
Yeah, absolutely. Well, thanks for coming out. before we end this segment, I want to ask you. Somebody needs to reach you to talk about. They say they want to set up a financial plan or talk about their finances. Just ask you a bunch of questions. How do they get in touch with you?
410-337-9146. Give me a call. I think my greatest advantage, the value I deliver clients, it's that voice-to-voice connection.
Yeah.
And you're never going to go into a call center. And so give me a call.
Yeah, great. Thank you. Okay. Well, guys, fantastic information. Love it. We're going to take a quick break. When we come back, we're going to get into the unreal and our spotlight. So we'll be back in just a sec. Try it. And we're back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with the Vesta Group of Frog Foster, sitting with my buddy.
Was that Long and Foster you said?
Frog and Bloster?
That's what it sounds like. That would be a great new real estate company. Frog
Dog, yeah. Dog and
Anyway,
Foster.
I'm Michael Becker of Sierra Pacific Mortgage.
I love my company.
I know
it's not my company, but you know,
it's the company you've chosen.
It's the company I've chosen to affiliate with.
Yes.
That's right. Yes, Long and Foster Real Estate Inc. Yeah. Right.
I'm sorry, my friend. I had to make fun of you.
You know, it's okay. You're just join the club, dude.
Well, I said an 11-digit zip code earlier.
You
right?
did, yes. So. But my kids. I have kids, so all bets are off. I am fodder for the whatever. It's okay. It's all
That's
good.
What kids do. They make fun of their own
Yes, they do.
Especially when
I
they
give
get
them
older.
plenty of material, so it's all right.
Absolutely.
Yeah. Anyway, all right. So
the unreal.
Something
that was strange or weird or didn't seem like it makes sense.
Yeah.
And we always discuss it and then give our spin on it.
Yes. So this week there was an article in the Basis Point, and
I do like that website.
Yeah, just today actually.
Okay.
And they were talking about a CoreLogic study, just published a little bit ago, June 8th.
Hot off the press.
That says, and this is terrible. The average U.S. homeowner lost $5,400 in home equity.
What's an average U.S. homeowner? I'm just kidding.
Well, from Q1 2022 to Q1 2023.
All right. So, first of all, let's define terms. CoreLogic is a big data aggregator for real estate. It's a lot of the reports, they have tons of data, and they just put it out there.
Yep.
And it's up to us
to interpret it.
Correct.
Yeah. So here's the.
So it was a decrease from first quarter of 2022
to quarter 1 2023.
So what happened up to quarter 1 2022 was incredible run up in specific in certain markets, right?
Yes, overwhelming run up. And then there were some markets that saw a negative reaction to that after things
because interest rates spiked so much.
Exactly.
So that's what we think has happened here. So I would say that average $5,400 is centered in some of the hotter markets like Boise,
Idaho, my favorite Boise. Yep, California,
I heard
Arizona,
that Austin, Texas, because a lot of people moved from California to Texas.
Yep.
That saw a huge increase, so I wouldn't be surprised if that saw a little bit of drawback.
Austin's actually still one of I think it's the number one millennial destination.
Yeah. I love it.
Yeah.
It's the one place in Texas that's more
liberal.
It's liberal, right? Yeah. It's very liberal. That's where the University of Texas is. So
yeah.
That makes sense.
Yep.
But $5,400 is quite a lot. And first of all,
nothing to sneeze at.
Nothing to sneeze at, but it is average. I wouldn't say people in the Baltimore, D.C. region probably saw that.
To your point.
Oh, you've got numbers.
Yeah, right. So the average U.S. homeowner has over $274,000 in equity, up from pre-pandemic times when it was 182.
Or you could say before the pandemic if you don't want to.
Or I could say before the pandemic. Yes.
I know, those tongue twisters.
Rented lips. Yes. Right. Round the rock. No, anyway. All right.
274,000.
274 up from 182.
So even a little straw down.
Incredible run up, right? That's over 50% increase since 2019.
Okay.
Now, in Maryland,
Okay.
Q1 2022 to Q1 2023, we increased $6,000 gain in equity.
Right.
So most of those losses, right, they're out west.
There are other
Seattle,
places,
Washington, Boise, San Francisco, lots of California. Yeah.
Some of the places that
Yeah.
I'm curious where that loss came from. Does it say in the article?
It's
loans?
Get ahead of ourselves. This is only through quarter one, and the spike in interest rates kind of did curb demand for a long time during that year period that they're talking about.
Yep.
Since the end of, and probably prior to the end of the first quarter, demand came back in a big way despite
very true
the higher interest rates.
Yeah.
And I don't know that it'll be interesting to
see if it persists.
If it persists,
Right.
I don't
Right.
think it will. In some markets, it may. But
I would agree. So there, in the CoreLogic article, they talked about if prices were to increase by about 5%.
Mm-hmm.
There's about 2.1% of homes out there right now that have negative equity.
Wow, that is
right?
something
They're
I
underwater.
haven't heard in a long, long time.
But it's a very small percentage.
Well, and they were probably people who put minimal down payments down.
Absolutely, right? So
and
if you had
remember, there are loans you can do 0% down.
That's very true, right? So in those markets, you put a small percentage down, you could be in a negative equity situation right now. However, if home prices increase by about 5%, they say about $145,000 homes could regain positive equity.
Okay.
If prices drop by 5%, about 213 could drop into negative. So there's that. It's that cusp, right? You don't put a lot down. Yeah, you can roll into that situation.
Can I say something as well?
Yeah.
Anybody that used a VA loan that had to pay a funding fee or a USDA loan, and both 100% loan-to-value loans, the day they close, they have negative equity because there's a funding fee or a guarantee fee for USDAs that you can roll into the loan. Even FHAs that require 3.5% down, when you close after rolling the 1.75% mortgage insurance into it, you're over 98% loan to value.
Right.
So it wouldn't take. I guess the point I'm trying to make is these negative equity numbers sound high, but they're really not high when you consider how many homes are out there. And I wish I had off the top of my head. I don't. The number of homes that were underwater after the housing bubble.
Right.
I'll have to look that up and bring it up next week.
Yeah, but significantly higher than 2.1%.
Yeah, exactly. Right.
Yeah. Now, you know what? One of the interesting things I saw in this study, too, was one of the biggest home equity winners in the U.S. was actually one of the smallest, too.
I get that because it's probably because of the population.
Tiny little state.
Rhode Island.
Rhode Island, yeah.
It's the biggest little state.
It's the biggest little state, right, yeah. But they, 24K in average appreciation.
Wow.
And only two other states beat them, and that was Florida and Alaska. So
I wonder how much the homes on the breakers went up.
Yeah.
Those homes aren't for sale. I think they're mostly in endowments, I would imagine.
Probably true. All right. Well, anyway, so that was the Unreal. We're going to roll right into the Spotlight. This week, we're highlighting Pairings Bistro in Bel Air. Right, so, Michael.
This is news to me, so I must
Enophile, Michael.
Yeah, they got a good wine list.
They have a very good wine list. That's their whole thing.
I'll be the judge of that.
Well, you need to.
I'm looking it up right now.
Take a trip. Their experience is all about matching up the best food and wine. Ooh. Right? So if you're an enophile, like Michael.
A global spanning wine list.
How about that? Yeah. They're in Harford County. And I feel like we haven't said Harford County enough love. Right. So I wanted to pick a Harford County restaurant. Like Pairings Bistro, I love it. 2105 Laurel Bush Road in Bel Air, right? They've won a bunch of awards, Harford Magazine's Best of Awards and Open Tables Diner's Choice Awards. Anyway,
yes,
food's great. Great wine list. They got other things to drink, too.
I can attest to that.
Yeah?
They have, for all the bourbon hunters out there, they have a fantastic list.
Ah, how about that?
Fantastic list.
Love it. Okay.
So it looks like I'm going to have to go there and find out for myself because they didn't. I can't find their online wine list to judge it.
You got to go.
So I will go.
Right? Maybe the
report
three of
back.
us can go up and have a nice meal. I like that idea. They've got shrimp and grits. They got a shrimp and grits, and they pair it with this nice Malbec that's, anyway, awesome. But they've got a lot really nice food. Anyway, they're open Monday through Thursdays, 11 a.m. to 10. Friday and Saturday, 11 a.m. to midnight. They're closed Sundays. They're on Instagram at Pairings Bistro, Pairings Bistro, or you can call them 410-569-5006.
They have a Father's Day brunch.
They have a nice Father's Day brunch. Absolutely.
That's not, normally, brunch is not that's a Mother's Day thing. I like the idea.
You ought to ask the family. Take them up.
Yeah.
Yeah.
That way I don't have to cook. It's Father's Day and you still got to work. You got to bring out the grill and
You got to do the grill. Yeah.
Instead of mimosas, could you imagine a Father's Day brunch, unlimited old fashioned?
There you go.
Somebody's driving me home.
Well, it's your day, Michael, so that's all right.
It should be okay.
Yeah. Anyway, so Pairings Bistro, check them out. Anyway, guys,
Yes.
that's it.
That's it.
That's the whole enchilada.
Love the chat.
Episode 21. Thank you, guys. Really appreciate it. Next episode, we are waiting on confirmation from another special guest.
Okay.
And so we should have that soon. But that's why I'm remaining tight-lipped about the topic.
Fair enough.
But yes. But you want to listen to us? Check us out on our website, www.berealpod.com. You can listen right on the site. You can also submit comments to us. We'd love to get your feedback so that you can tell us what you think, how we're doing. Are we idiots? Do you like it? Whatever.
Well, that's an easy. I can answer that question. Yes.
Yeah. Or if there's something you really want us to talk about, love to hear it. So let us know. We're also on all the major podcast platforms, and we're on YouTube if you search for @BeRealMDPod. And if you're on YouTube, obviously we'd love for you to subscribe and like and comment and share. That would really help us out. If you know of anybody who would benefit from the information that we shared today or in any other episodes, please feel free to share that with them. All right, so Michael.
Yes, sir.
Somebody needs to reach you to talk about mortgages. How do they get in touch with you?
What if they just want to chat about anything I mentioned on this podcast?
Sure, anything.
Welcome. The phone call would be the best way to reach me, and you can call me on my cell.
Yep.
443-310-0012. I also answer texts if you decide to do it that way.
Yep.
And 443-310-0012. If you prefer email, you can always email me at michael.becker@spmc.com.
Great. And if you need to reach me to talk about real estate, that's 410-375-7550. Either call or text, or email at brad@homesbyvesta.com. And Jason, one more time for you, if somebody needs to reach you.
Yes, sir. 410-337-9146.
Beautiful. Fellas, thanks again.
Thank you.
Great information. And folks, thanks for listening. Tune in next week for the next episode of Be Real,
The Maryland Real Estate Podcast.
Thanks, everybody.
Trap.